Meet Jake and Marcus. Their starting variables are identical. They are both 30 years old, earn $75,000 a year, and have committed to investing $1,000 a month for the next 3 decades to build their retirement. Jake treats investing as a specialized craft. He spends weekends analyzing earnings reports and news cycles to curate a concentrated portfolio of what he views as the highest quality companies, high growth names like Nvidia, and established megacaps like Apple. Marcus chooses an approach that requires zero research. Every month, he buys a single S&P 500 index fund and walks away, ignoring financial headlines. Early on, Jake feels like he's outsmarting the market. At neighborhood barbecues, he can brag about his Nvidia position being up 80%. Marcus has nothing to contribute to these conversations. He just watches a number go up on a screen. Human psychology creates a selective emotional scoreboard. We prioritize the memory of massive winners we can talk about, while quietly burying the losers we sold at a loss, creating a mirage of outperformance that doesn't exist on the actual brokerage statement. Fast forward 30 years to retirement. Marcus's hands-off strategy compounded into a final balance of approximately $1.78 million. Jake's active portfolio ends with $1.17 million. He faces a shortfall of over $600,000 compared to the index fund. Jake remains unaware that he even lost. Because his account balance grew every year, his winning picks provided constant false confirmation that his strategy worked. 3 silent leaks steadily drained Jake's wealth, punishing his concentration with a precision that no single market crash could match. In 2018, Arizona State finance professor Hendrik Bessenbinder published a study analyzing the lifetime returns of every common stock traded in the U.S. since 1926. 57% of stocks fail to beat a risk-free treasury bill over their lifetimes. Market returns are driven by an extreme minority. Just 86 companies, under 4%, created half of all U.S. stock market wealth. While holding a generational winner like Amazon from the beginning would beat any index, doing so requires the impossible foresight to identify that specific winner in real time, decades before its success is certain. In March 2000, Cisco Systems was the undisputed Nvidia of its era. It was briefly the world's most valuable company, and Wall Street considered it the obvious way to play the future of the internet. An investor who bought Cisco at that peak in 2000 spent the next 25 years underwater, only breaking even on the stock price in late 2025. Broad index funds eliminate the risk of picking the wrong era's darling. By owning everything, they guarantee the capture of that critical 4% of companies that actually drive the market's long-term growth. The second leak is tax drag. Every time Jake rotates into a new position or sells a winner to lock in gains, he triggers a capital gains tax event that pulls money out of his brokerage account. Over 30 years, Jake hands roughly $63,000 to the IRS due to high turnover. Marcus, using a tax-efficient ETF, pays only $8,500. This capital is permanently removed from Jake's compounding engine, erasing decades of potential growth that Marcus enjoys. The third leak is the behavioral penalty. Retail investors are hardwired to sell their winners too early while holding on to their losers for years, hoping to just break even. The Spiva report shows this isn't just a retail mistake, it's a systemic reality. Over 15 years, nearly 90% of professional fund managers, the people paid full-time to pick stocks, fail to beat the index. Stock picking is a game where your own brain chemistry and the tax code work together to quietly drain your net worth. The index fund holds one final advantage for long-term wealth: the step up in basis at death. When Marcus leaves his portfolio to his heirs, the cost basis resets to the current market value, wiping out decades of capital gains taxes. Jake's wealth was continuously taxed away during his life, a cost his estate can never recover. The index fund functions as a mathematically ruthless mechanism designed to capture market anomalies while bypassing human error and tax drag. A practical framework for most investors is to build 90% of their core wealth in low-cost index funds, keep individual stock picks under 10%, and strictly quarantine them inside a tax-advantaged Roth IRA to eliminate the tax drag of active trading. Capturing the market's true wealth provides a boring, reliable guarantee that far outweighs the thrill of searching for the next apple.